It's getting worse. The liquidity crisis is no longer in the distance. It's already started. Data just in shows SOFR spiking above the Fed ceiling, indicating the central bank is rapidly losing control over the $3 trillion overnight repo market. And it gets even worse. The Fed funds ticked up yet again, and the emergency SRF just got tapped yet again. After months of warnings, the squeeze is on. What happens next? So, as we can see, the Standing Repo facility, the SRF, the Fed's emergency liquidity backstop, just got hit today for another $7.7 billion. That's in addition to yesterday's $8.5 billion. Remember what this is: a Fed facility when there is a shortage of cash, when financial firms need to pledge collateral to the Fed and get cash in return. Not only that, SOFR continues to move higher, now above the discount window rate, indicating the Fed might be losing control on the overnight cost of capital, the overnight interest rate for these dollar loans. And not only that, but the Fed funds rate is also ticking up yet again. So despite Fed rate cuts that we keep hearing about, we got one last month, we'll likely get one in another couple days. Despite that, the federal funds rate has actually ticked up, as you can see from the white line here. Remember, the Fed funds much smaller than SOFR. That is the unsecured overnight lending market interbank interest rate for those overnight dollar loans. We're going to focus on SOFR though, because that is the $3 trillion overnight repo market. We can see SOFR is now above the discount window rate. So why is that meaningful? Again, the Fed uses a corridor to try to control the overnight interest rate. They set a floor with the reverse repo where they say, no matter how overabundant dollars get, we will always buy them from you at 4%. That's the current interest rate for the reverse repo. Then on the other hand, they have the discount window rate, which is the Fed saying, no matter how scarce dollars get, we will always sell them to you at 4.25. And so by setting that corridor, they are trying to control the overnight cost of capital. And we can see generally they are able to do so. However, at month end or at quarter end, you do see funding stress, as we can see here from the blue and purple lines. SOFR does start to move higher relative to the reverse repo, which is the spread that we're looking at in the lower pane at the end of the month or the end of the quarter, or at tax deadline, which was mid-September. But again, it is none of those things. So we actually went above the discount window rate here for 2 days, the 15th and the 16th in mid-October. We are now above the Fed's ceiling yet again, indicating if this continues, that the Fed might have lost control on the cost of capital on this overnight interest rate. Is extremely important. Obviously, $3 trillion financed in SOFR every single day. Not only that, but we can see that it coincides with a rapid, increasingly frequent usage of the standing repo or the SRF, which again is the Fed providing dollar liquidity to the financial system. It's the exact opposite of the reverse repo. So the fact that the two are coinciding together, you have a surge in usage of the SRF, and you have SOFR starting to move higher relative to IORB or reverse repo. It's the same story no matter which interest rate you use. Now above the discount window rate is all saying the same thing, which is there is a significant shortage of liquidity in the financial system. And again, down here, you're looking at a spread between two different interest rates. So for minus the floor, that interest rate that the Fed sets as the floor. Now, if I remove the day-to-day volatility, you can see there's been a clear trend. This has been developing going all the way back to July or August when we first flagged that this might become an issue. Now, here's an AI provided summary. I thought some people might be interested in that. I gave it all the data and I said, objectively evaluate the degree of funding stress in the overnight repo market. That is what it said. So you can pause the video and read that. But again, the Fed's engaged in quantitative tightening. That's negative for dollar liquidity. You also have the Treasury General account being built back up. And again, to do that, to build up the checking account balance, they have to remove dollars from the financial system. Not only that, but the reverse repo, which is the Fed's kind of emergency shock absorber, that is empty. And not only that, but we are running, of course, massive deficits that, again, are another negative liquidity strain. So we have a number of liquidity strains all happening at the same time. Jerome Powell just last week came out and actually talked about SOFR and actually talked about the repo markets and some of these SOFR spreads and said, yeah, dollar liquidity conditions are getting pretty tight. We might end quantitative tightening. And as we will see in a second, by the way, this reverse repo SOFR spread coincides quite nicely with bank reserves inverted. But as we can see, of course, an increasing frequency of the standing repo being used. Again, that's an emergency backstop when there's a shortage of liquidity. And as we can see, it is coinciding with a surge in this SOFR spread, again, above that reverse repo. Remember, here's another way to think about it. This is the reverse repo, which is a Fed facility for excess liquidity, minus the standing repo facility, which is, again, a backstop when there's a shortage of liquidity. It is a spread between two different things, and it can tell you what regime you are in. We are starting to go negative on this for the first time, going all the way back to 2020. Now, right now, as of the most recent data, it is positive by just 3 billion. And remember, the reverse repo, you can think of that as a storage tank of excess dollars that was kind of a buffer or shock absorber. Well, that is empty now. So there is no buffer left. The Treasury was removing cash by building up the TGA. We have some massive Treasury bill auctions, $110 billion. Again, that is removing cash from the system. The Treasury gets cash, someone else gets collateral. And remember, back in 2019, there was no shortage of collateral. There was no shortage of US Treasuries. The problem was everyone had way too many US Treasuries and not enough actual dollars. That is what we are starting to see again. And of course, bank reserves inverted. Remember, bank reserves are one half of the monetary base, or the M0. It is bank reserves plus currency in circulation. That is the M0, or narrow money. And we can see that the bank reserve component has declined from about 3.4 trillion just a couple months ago to now just 2.9 trillion. There's a concept called lowest comfortable level of reserves. No one really knows where it is. Some estimates have been 2.7 trillion, but really the answer, as we can see, is quite correlated, inversely so, with SOFR minus the reverse repo, at least a moving average of that. And we can see that as that SOFR spread has moved higher, indicating more and more liquidity strain, that has coincided with a decline in bank reserves, as we can see from the green line. Now, here is straight from the Fed. I will link these in the description in case you are interested. We can see the SRF usage today, 7.7 billion. Here is SOFR, again, with the distribution, if that is interesting to you. Here's the federal funds interest rate. Again, volume weighted median is what we were looking at. Here's a thread from Jim Bianco that you can find, very well-respected macroeconomist, warning on October 20th about elevated SOFR spreads and liquidity strains. A very, very well-respected guy. And then here's an article from RIA, also talking about the red flag that is being raised by this. Now, I will link this Wall Street Journal. Hopefully there's no paywall. I will link this in the description, but an article by Nick Timmeros talking about how QT most likely needs to end and how unusual it was for Jerome Powell to talk about the overnight repo market, relatively boring thing, not generally discussed by Fed officials. So they are clearly aware of these elevated liquidity strains, and they are planning to probably end QT at this upcoming meeting. Now, will it be enough? That is really the question, because what they need, the way they fixed 2019, was by an injection of new dollars. The way they did that, the Fed printed the bank reserves, and they bought U.S. Treasuries or mortgage-backed securities from the banks. And so, therefore, the banks now have cash, and the Fed now has more assets on its balance sheet. We can see the Fed balance sheet went from about 3.7 trillion up to about 4.2 trillion dollars before, of course, 2020, and we all know what happened there. And of course, it coincided with an increase of bank reserves. That is that half of the monetary base that can provide some much needed liquidity. As we can see, it is moved down sharply. Again, QT is adding to that. Massive Treasury bill auctions are removing cash from the system. The reverse repo, which is the Fed's kind of buffer or shock absorber, that is now empty. You have the Treasury building back up the Treasury general account, all of these are negative for dollar liquidity, at least when it comes to the financial system, the plumbing of the financial system. And again, the answer is always more liquidity. The way you get that is the Fed prints bank reserves and then buys assets like treasuries or mortgage backed securities. That is known as QE. So, whether or not an abrupt end to QT will be enough, we will see. They've clearly slowed the pace of QT, as we have seen in recent videos where you look at the rate of change of the balance sheet. We can clearly see that pace is slowing, but will it go to QE where they're actually printing bank reserves and increasing their balance sheet? SOFR, the standing repo, you add it all together, even the federal funds rate moving higher despite the Fed cut last month and another cut likely coming here in a couple days. All of these added together, of course, we can see the standing repo. That is an emergency liquidity backstop that is very, very, very rarely used. This chart goes all the way back to the end of 2020. You can see it is very rarely used, at least above $1 billion. There can be very, very small movements in the SRF, but I only marked any time that it's above $1 billion. A notable use of the SRF is quite rare and is coinciding again with an elevated spread in both the Fed funds and SOFR. You add it all together, the Fed might have to start QE again. And of course, that is the question on everyone's mind. The other question being, what happens if there's a repo rate crisis? We wake up tomorrow and SOFR is 500 basis points higher. Well, the Fed's answer again will be to print money. You should expect probably volatility that day, but medium to long term, probably no meaningful impact on various asset prices, because again, the Fed will rush to the rescue with a dollar bazooka, with the printing press. They will fire that money printer up. They will print the money and inject it into the financial system, probably around $1 trillion. I mean, they will not be afraid to print a lot of money and inject it into the financial system. But it is undeniable now that liquidity is becoming quite scarce, or again, at least liquidity that is willing to be lent out by the various participants in the SOFR, in the repo market. Again, there might be no shortage of dollars, but if everyone's worried about counterparty risk, then they would be unwilling to lend those dollars. Therefore, you get the same effect, which is an elevated SOFR spread. So anyways, hopefully that was helpful, and I'll catch you in the next one.